The last week saw stock market indices around the world plunge. The Nasdaq took a 13% hit. So is this the end of the slide or the start of a new bear market for tech stocks? Hello, I'm David Jones. This is our YouTube channel dedicated to technical analysis of US stocks. Even if you are a casual observer of financial markets, you will know about the incredible volatility that's come back over the last week thanks to the spread of the coronavirus outside of the Chinese borders. So in this video, we'll catch up with the moves on the Nasdaq, come back, talk about the reasons why, what to watch out for, the big levels to look for, and then we'll jump back onto the chart and look at things in a lot more detail. As usual, if you're watching this and you haven't subscribed, if you can click on subscribe, support the channel, and we will continue to push out at least a couple of videos every week on US markets throughout 2020.
So here's the year so far for the Nasdaq 100. So it comes into the year about, 8750, 8800. Saw this rally, 1,000-point rally nearly, up to mid-Feb, up around about 97.33, and then loses a massive amount. It's been like 1,500 points in fairly short order off those highs, and clearly it's a massive turnaround in a couple of weeks. But what's interesting, if we take this out to the bigger view, does it really change the trend that's been in place since those December 2018 lows? So we're over a year into this move. Is this panic caused by coronavirus just a buying opportunity?
So the market came into February pretty much how it's been over the last few months. We saw once again fresh all-time highs hit by the Nasdaq, continuing to power ahead, up almost 10% for the year so far. Then worries about the coronavirus really shook investors' confidence as we saw it spread outside China's borders over the last week from the 19th to the 27th of Feb. We saw the market, the index, drop by 1,300 points, a drop of just over 13%. You know, clearly that is a massive move in such a short amount of time. And we had the situation where as the markets was dropping, the selling was feeding more selling. And as we saw back in the financial crisis 10 years ago, it really did have masses of momentum to the downside. And the reasons are clear. It's about the effect that all of the coronavirus concerns and the spread could have on global growth. You know, we have the obvious hit potentially for companies such as Apple, who have so much of their manufacturing in China. China plays such a major role in the world economy. The OECD, the much respected think tank, has downgraded its outlook for global growth to 2.4%. Back in November, it was saying almost 3% in 2020. So it is a big adjustment. Then on Monday, the Dow, the S&P, the Nasdaq, we saw their biggest one-day points gain in history. So that's just at the beginning of the week, and that was on hopes of maybe some sort of central bank stimulus for financial markets, you know, possibly a rate cut, something like that. But we did see these markets bounce back strongly. As usual, the question is this actually the start of a recovery? Or is it just a dead cat bounce where markets rally and then turn just to plunge ever lower? Let's take a look at the big levels to watch. So the obvious hurdle on the upside, which is a way away from where we are now, are those all-time highs, you know, reached just over a week and a half ago. So up at 9740, 9,740. And after that, we've got various levels, various psychological levels. On the downside, again, we've got to go quite a way back. So we've got the most immediate low reached so far in this sell-off, 81.30. That's going to be pretty critical. I think if it breaks below there, the risk is we're going to see accelerated selling. Then after that, we go back to October, 74.60, those sort of lows down there. But let's take a look on the chart and put some color on these numbers.
So let's take a look at the Nasdaq in a bit more detail. At the time of recording, we've just had this emergency interest rate cut by the US of 0.5%. So we're seeing pretty volatile reaction by markets. Initially they rallied, but they're not quite sure. But I thought what we do, let's just take a step back from this short-term noise and look at the bigger picture. Look at the falls from the last week in the context of where we are. And I think this is the important thing to look at. Going back to the lows, December 2018 lows, around about 6,000. Clearly the market's rallied more than 50% since then, up to those recent all-time highs up above 9,700. Market got clobbered as the coronavirus spread outside of China. But I think what's interesting is where so far the sell-off has stopped. And I think these are the big levels to watch. We have the old highs from the summer of last year when we were worried about a recession coming, the inverted bond yields, lots of talk in the summer about recession. And we saw 8,000 really capping the market And that does, so far at least, look to be helping support the market. The old highs, pretty major highs that held all the way in to late October, have held the market up in this sell-off. Then we've had this recovery, or the trend, I should say, that's been going now for about 14 months. And again, coming in around about 8.2, 8.3. So I think that this whole 8,000 to 8,300 area, really important one for the Nasdaq 100. And for now, if we took a step back and ignore the news, as hard as that might be to do, it does look like a buying opportunity. I think, clearly, I think we need a few days for this market to settle down. Let's see if it sells off from here. Do we see buyers come back in ahead of 8,000? But for now, I think the target would be for a run back up to those all-time highs above 9,700 on the Nasdaq. Looking at the RSI down here, it's a 10-day RSI, so we are pretty oversold. Not surprising given the sell-off the market's been through. Got to go back to early August to see the RSI this sold off. Just because it's oversold doesn't necessarily mean the market can't go any lower. If we look back here in May of last year, very oversold, slight blip up in the market, dead cat bounce and bang, the market sells off again into the end of May. But I think for me, it is all about price from here. And I think we've got this trend since December that's still in place. The old highs at 8,000, big support potentially. The market traded as low as 81.30. So I think this is pretty critical. And while this holds, for me, that trend remains intact. And the target is for a push back up to the old highs. If we start to lose this 8,000 level, I think the risk is clear that we could see more selling off the back of it, a weaker market fueling more selling and targeting a run back to perhaps those August lows around about 7,400. But for now, while that level holds, still looks positive.
That's it for this update. It is, of course, going to be a really interesting market to watch. We will come back to it in a couple of weeks' time and see how things are. But for now, from me, David Jones, good luck with your investing and trading.